All right, I want to move on to the bubbles and innovation research. I love this topic, and this paper is very cool. How do you define bubbles in your research?
Indirectly. So we don't try to be the true sayer to say we know it's going to be a bubble in advance. But we use a method that some other researchers actually came up with, and to say, well, if it looks like a bubble, if it sounds like a bubble, if it smells like a bubble, then there's a good chance it's a bubble. Of course, we try to be not forward-looking. So it's all based on backward-looking measures, so that we don't cheat in a way and just define a bubble by the fact that it has crash exposed. But we look at episodes, like industries, where there's been a big price ramp up over the past few years, and at the same time there's been big increase in trading volume altogether. And so what other people have shown is that this is not a perfect way to detect a bubble. There will be lots of false positive, but on average, this is much more likely to be a bubble than a typical episode, this kind of period. So it's a way to say, well, episode where all of us would look at market and say it's a bubble or it's likely to be a bubble. That's what we call bubbles in the data. In our theory, for us, a bubble is an episode where people speculate, disagree, make prices being too high.
So you're taking industry portfolios and then defining a bubble as an industry that's had a big price run up and a big increase in trading volume in recent. Yeah. Okay.
In past, I should have looked at the paper more detail recently, but I think in the past 2 years.
Okay. Yeah. Makes sense.
Both a big run up on. I think it needs to be both a big run up for the industry and relative to the index. So it cannot be just that the whole index is climbing up.
Got it.
How do you measure the value of an innovation?
So here as well, we leverage some research, but that other people have done, but that's kind of a cool idea. So first we should think it's hard to measure the value of an innovation. Like we have like something like ChatGPT comes out. We all understand that it's extremely valuable, but how valuable is it?
Yeah.
One simple way to define that is to think, well, what are the consequences of this innovation? So, you're going to keep track of all the profits that OpenAI is going to make. That's what you could call the private value of innovation. So to the innovator, there's social value also that like other people will make more profits. So you can think about this in your head. Now, measuring the profits of OpenAI is okay. The other people profit from this innovation is already gets tricky. But you can start thinking through that. The idea that we're leveraging up, and that is something that we're going to criticize, is to say, well, you can try to use the stock market. So you could say, well, take the day where OpenAI released ChatGPT. This is not a great example because they were not that public, but take the day where, so formally what we do is take the day where the USPTO approves a patent by a firm and looks at how much the stock price of that firm goes up when this patent is approved. So this stock price, this increase in dollars, not of one share, but of the total market capitalization, is telling us how much value was created by this patent being approved and released. And there's lots of evidence that people pay a lot of attention to those releases. So that's the way to measure the value of the innovation.
That's the market value of innovation, right?
Like what we call, So in the paper, we try to separate those two values. So in the ideal world, those two numbers are the same in a way. The actual realized value or not necessarily realized, but expected realized value and the market value. But we in the paper we try to measure the two together to see, well, do they always line up? Starting point was this concern, and we say, well, but when there's lots of innovation, so that's when we really need those measures. There's also lots of speculation, and we start to worry that market prices might be off.
So how does the market value of innovation change during bubble periods?
It goes up. So maybe, it's not as obvious as it seems because, we all know during bubbles, like the market values go up, but that's not what we measure. So we measure how much the price change, how big are the price change after the release of innovation. But it turns out those are bigger as well, where the market does price everything bigger. And so we see these big reactions to innovation. And of course, the part of it should not be unexpected in that while we have big waves of innovation, the innovations are better. So we should see the markets value those innovations better. But I think what we've kind of find out, both through kind of theory and trying to look at different measures, is that it looks like it's too much in a way. So it looks like these price increases are larger than what's justified by the subsequent performance of those innovations.
That is super interesting. So the market tends to respond positively to patents, but during bubbles, the response is more extreme.
Yeah. If you look at, for example, how do the profits of a firm respond to a patent, it also responds positively subsequently, but not more so after a bubble, during a bubble.
Wow.
So we see kind of this disconnect in a way between the market start to value things a lot, even though they don't have better consequences.
So that's kind of the next question, I think, is what effect does innovation have on real outcomes?
So it has positive effects. So I mean, there are large effects. Again, the point of that paper is to point out, some issues, but innovation is valuable and is valuable to firms and so on. But what we find is that in a way the market kind of overvalues those innovations relative to the gain they provide in terms of actual real outcomes, profits, sales, and so on.
So it's like they produce good real outcomes, but when you look back, the stock prices react more positively than they should have?
Yes, exactly.
And how are competitors of the innovative firm affected by the innovation?
So that to us was kind of the flair that really made us think that it has to be a bubble. So when I do an innovation and you're my competitors, this is kind of bad news for you typically. You could say, well, you can build on my innovation, but at first order, I step ahead of you. And so competitors tend to suffer. And so if you look outside of bubble, that you see this phenomenon. So you see the stock price of competitors drop when an innovation patent is approved. And you also see subsequently the sales of those competitors, the profits of those competitors go down. If you look during bubbles, you still see in the real outcomes, you still see that the sales will suffer. You still see that those other outcomes will suffer. But now you don't see a stock price reaction. So in a way, the market is giving too much credit to the firm that innovated, but is not punishing the firms that are suffering, that are the kind of the losers of the innovation process.
Wow. And that's because they're in the same bubble industry?
So the way we thought about it is actually by trying to dissect a little bit what does it mean to be in a bubble? Like how do bubble pricing work? So it might be a little bit strange, but bubbles are not just a big mess where people overvalue everything in a way. So the overvaluation is an outcome, but we thought maybe there's kind of method to this madness a little bit of the bubble. So the kind of mechanism we had in mind was something based on disagreement, that different investors have different views on who are going to be the winners. So if we go back, we're talking a little bit about AI. It's like, I might believe that OpenAI they're the ones that they're going to be the big successful innovators. Versus Cameron you might believe that Meta is going to get all the profits. And so now what this does is that, well, I'm going to be the investor in OpenAI naturally, and Cameron is going to invest in Meta. We start to get this specialization of investor in a way. It's kind of like fan clubs for various stocks, and of course the fan clubs of each stock is investing in that stock. So now if you start thinking what happens when you get a good news about OpenAI, the people who are valuing it are people like me who love OpenAI. So then the stock price of OpenAI is going to climb up like crazy because they're like, well, I already knew OpenAI was amazing. I get this good news. It's so amazing. Versus Cameron, from his point of view, he's the one that matters for Meta. You're the one that matters for Meta, sorry. And you hear about OpenAI, but you're like, well, OpenAI sucks. This is, who cares? Like, I know Meta is going to be the best, so they can innovate. It doesn't matter to me. So why would I worry? So it's a little bit like, we're going to run a race and we each think we're the best in the race in a way. So if you tell me, if you think you're going to win, if Cameron thinks he's going to win and I break my leg, he still thinks he's going to win. Or if I get better shoes and I run faster, he still thinks he's going to win. So that's how you get that the competitors don't respond in a way, is that everybody has strong belief into their own firm, and competitors don't worry, and the firm that innovates gets all the gains.
That's really interesting. It's like the cult of Tesla kind of concept.
Yeah, exactly. Yes. Yeah. But you see, you see both the cult of Tesla and the competitors don't suffer that much, So
Right.
the cult of Tesla tells you why Tesla is going up so much. Again, it's not like we show for Tesla specifically, but if you apply this, the cult of Tesla tells you it's so good, but people like Ford so much. People who invest in Ford like Ford so much, they think electric cars don't matter, so Ford doesn't suffer too much. I think we like these two sides of the same coin. I think is what to us was kind of a big a kind of flare gun to say, well, this is what's going on.
So, what are the implications of this research for, I guess, innovation policy?
So it depends how much innovation you think we should have. So a common view, and maybe the most common view, is innovation is always good in the end. And so what underlies that view is this idea that say, well, there's always going to be good spillovers to innovation. So, when let me not talk about AI actually, because I think there's lots of debate around this these days, but it's like we get better computers. That's going to be good not only for whoever came up with better computer, but like over time, all of us will get more computing power. Everything will get better. And of course, but if you're the person creating the computer, you don't get gains from those spillovers. So there's a common view that there's just not enough innovation. And so then in that view, bubbles are kind of good news because they amplify the incentives for innovation, and they create more incentive for innovation because you can ride the bubble and get extra gain in terms of market capitalization. So that's the positive view. And so to say, well, as innovation policy, you should be aware there's a bubble, so you shouldn't overestimate how much innovation is going on. But at the same time, it's good news that innovation is stimulated. The flip side is that the bubble can create kind of overinvestment. So if you're not necessarily so convinced that we always need more innovation, we always need more investment, like if we go back to Tesla, for example, it's like you could say, well, it's great, like this huge Tesla bubble kind of completely accelerated the development of electric car. But the issue though is there's a bubble. So people will lose their job. Tesla will suffer subsequently compared to the peak. And we see sales go down, we see jobs being lost, and these are real consequences that are some fragility, and I think we should also be concerned. So I think the first order message for policy maker was more watch out in a way that you can gain from bubbles, but like at the end of the bubble comes and the long-term gains from the innovation are still there, but many people who partake in the bubble are going to suffer a lot. So you would have to balance those aspects.
So you touched on this, but what are the implications for investors hoping to earn high returns by investing in innovative firms?
Be careful. Be careful. I think like this is an extremely common pattern. So we went back through a lot of history actually. Like it's like not only our data, but we try to read a lot about this, and because people, when we talk about bubble, the historical example, people talk about like the tulip bubble, things that are like bubbles on goods that don't matter, like gold bubble, but it turns out a lot of bubbles look more like tech bubbles. Like there's something new and exciting. It's clearly good. It's clearly valuable, and people rush to try to develop the technology, and so sometimes you win, but because the technology comes to fruition, but often there's overvaluation along the way, and prices drop subsequently. I think the other thing to me that is important to realize is it's really difficult to pick winners. That's why like OpenAI like the AI as AI has been developing, that's something that keeps coming to my mind. Is like OpenAI showed up, nice, a huge firm, and I have nothing negative to say about them. I don't know that much, to be honest. But it's if I ask you, well, in 4 years, is OpenAI going to be the leader of AI? Who knows? If we go back to the beginning, I was thinking like go back to the beginning of like online commerce. We thought like eBay was going to be the big online commerce. I think eBay was the clear leader. Well, it turns out it's Amazon who won. And so even if you're doing the right bet, if you're betting on the right technology, I think we have a bias of like betting on thinking we can identify who's going to win. And that's something to avoid. I think it's like, I would say if you want to bet on AI today, first it's risky because there's likely a bubble, I would say. But also you don't try to pick winners. I think you will have lots of failures along the way.
Yeah, totally. I think there tends to be crazy skewness in technology bubbles where even if you're right about, it's like what you said, if you're right about the industry, it's going to be one firm that drives most of the value creation and you can't know which one it's going to be.
Yes, exactly. Like, it's like these days, I think we would think like, so people have different biases or different priors in how they evaluate that. I think many people would say OpenAI is the first one, so they're going to be ahead of everybody else. I think historically that there's no evidence that this is true, but many people think like that, I would say.
Yes, for sure.
Many other people would think, well, for example, Meta, they have a long, or Google, they have a long track record of success in technology, so they will be able to take them over. That's also plausible, but again, not clear that happens. Often we see new firms come out. So that part, I think, is the part that amplifies the bubble in a way, and is quite dangerous for investors. And I think that investors often don't realize.